This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant here. I'm the host of the Smart Property Investment Show. Hope you're well. Trading finance, it's the topic that everyone wants to cover these days because I reckon there's either a lot of people who are struggling with these interest rate rises, which we seem to be getting reprieves, or people trying to maximise investing in this environment. I know a lot of people I chat with talk about very good times for investing in property, and if you don't know, there's some big stuff happening here, which you'll see soon, depending on when you're tuning into this, around where to invest moving forward. But I'm here to talk about mortgages. Joining me in my studio, a regular guest, Eva Laurence from Finny Mortgages. Eva, how you going?
Well, hey, how are you? Good. Thanks for having me again.
No, it's good. You guys are always busy. How are you finding the market right now? Are the banks getting some sharp deals out there?
Yes and no, but we definitely have a huge new interest in people buying property. I think the market's turned a little bit and people are coming back. Yeah.
So people are just going, hey, I want to start buying again. Give me some debt.
Yeah.
That's good. So the team pretty busy?
Yeah, we've been quite busy.
Yeah. Who's buying at the moment? Give me a sense of the type of people buying.
So it seems like it's actually new-ish investors. They maybe have one property, but most of them would actually have 9 and decide that it actually might be the time to get into it.
Now, what sort of bracket are they sort of buying at? What sort of properties are they getting?
Sub 500.
Okay. So they're all out in Perth and South Australia and Queensland. Right. Yeah. Perth's running pretty hot right now. You read all about it on smartpropertyinvestment.com. We're covering it quite a lot. But you'll find probably either in this environment, there's a lot of people now who are going, okay, well, we now know where interest rates are going to settle thereabouts, whether there's another rate rise this year or some commentators are pricing in a rate cut at the end of the year. It's pretty much going to be like this for the foreseeable future, would be my read. Expect sort of interest rates hovering around where they are right now for the next couple of years. Would you subscribe to that point?
Yeah, I would agree. And very interesting to see that some lenders have actually started to reduce interest rates for fixed loans.
Okay. What sort of fixed rates are you getting at the moment with the mainstreams?
Yeah, for, let's say, an occupier, it would be around 5.8, and investment a little bit higher. Okay. But yeah, we've seen lenders actually dropping fixed rates, which says a lot.
Are you recommending fixed rate products for people, or you're saying hold the line on variable?
I would wait a little bit, but I guess we can see a start of probably have reached the peak of the rates. Of the rises. Yeah.
Well, that's handy. And so property investors, if you can start investing and it's time, you could probably move with a lot more continuity, stability moving forward, particularly if you're squared away on the home front, that you've got good steady income, the family balance sheet is squared away, all that good stuff. Now, you find it, and we get a lot of comments coming into the show, editor at smartpropertyinvestment.com, that you're around mortgages, Eva, and we're sort of curating them. We'll do a big Q&A at some point, but what we're seeing, and we like to do scenarios on this, and this is, this particular podcast, dialing in with you and the team over at Finny Mortgages, getting a sense for what you're seeing real world, what's happening right now, what sort of clients are coming across your desk. And we like to do case studies. And one thing that's popped up a couple of times you've told me recently is people who are saying, okay, we've got a sense now for where the market is. We want to start either expanding our portfolio or starting in property, and all systems go. They've got good incomes, and on paper they sound pretty good. But when you look under the hood a bit, you work out there's a lot of unsecured debt in there, and largely they don't have the serviceability to cover investment finance debt because they're so over-leveraged in non-property related debt. You're seeing a fair bit of that these days?
I think that's, most people, like anyone's neighbor, would have a credit card, a bit of a car loan for the car they bought a few years ago. They might have done a bit of traveling or renovations, and I've, accumulated a bit of debt in sometimes personal loans, or sometimes even through Afterpay and Hums and all these facilities now, that it's just so easy to spend without really knowing you've spent that. So most people would have easy $20,000+ worth of debt that just sit there and just cost a fortune every month, which completely kills their servicing option.
So this isn't access to the debt. This is actually they've subscribed in to the facility, whatever that is. So they're up to their eyeballs in it. So, I have credit cards, but I clear the balance every single month. I never carry a credit card balance. You get 55 days interest free. You get points and all that sort of stuff, right? It can be a really good tool. But so what you're saying though is that a lot of people you see actual carry an ongoing balance on their credit cards, probably paying 21 to 22% interest on it.
Yeah, that's the issue. And then they would only pay the minimum, every month, which is, sometimes $200-$300, sometimes more. And that just, doesn't repay the debt. And when you actually look at the bottom of your credit card statements, it actually tells you if you only pay the minimum, how long it would take you to get rid of it. And often it's 20 plus years, which for debt that's like 15,000, it will end up being, I don't know, maybe $50,000 worth of repayment, which is, it's insane. Yeah, so that really stops people from going ahead with the property investing, or even sometimes just buying their home.
It's surprising. And, I've always cleared my credit cards. I don't want to pay 21, 22% interest on anything. I'd rather use someone else's cash for 55 days and then get all the benefits of that. And I can't remember the last time I paid interest on a credit card. It might be when I forgot to make a payment or something. I don't know. But a lot of people use them to sustain lifestyle and buy stuff that they probably shouldn't be buying, thinking, I'll get it cleared out on a rainy day. Credit card companies love people that hold a credit card balance. They only want you to pay the minimum because the higher the balance, the more they can charge you. Now, a lot of the criticism around credit cards is they make them too accessible for people. Younger people who might not have the diligence or discipline to actually understand the ramifications of credit card debt. And they can find themselves in trouble from a very young age, holding credit card balances that they can't clear. And the same thing applies, that your afterpays and all the other zip pays and all the other sort of buy now, pay later type scenarios. They badge them up as an enabler for people and helping people sort of manage their finances and getting the stuff you want. And you don't have to pay any money or interest on it as long as you make your repayments. But they're all set up that you hold a balance and you pay fee. You would have to pay it eventually. Yeah. And I know a lot of young people have got caught out with that sort of stuff, buying a dress or buying something that they probably, a new pair of shoes that compounds with another pair of shoes and another pair of shoes, month on month. And then you end up with a big balance and you can't pay it off. Now, a lot of regulation has now gone into these sort of buy now, pay later type stuff, thankfully, because I think they're a curse. I reckon people should go back to the old days. And I remember when I was at university, I used to work in a big toy shop, one of my university jobs, and one of my jobs was to manage the lay-bys. So I used to be the guy who had to go and update. People would buy something and it'd be going to the back of a storeroom somewhere and they'd come back every week or every month or whatever it was to pay that little bit more so they could pay it off. And then I remember sort of around Christmas time when everyone will come and collect the stuff. They've been paying it off for 6 months so they can actually buy it. So that's like pay now, get later, which is completely the opposite. Life was simpler then, Eva.
Super, yeah. It should be if you don't have it in cash, just don't buy it. Especially if it's as you said, a dress or shoes or whatever.
Yeah, I don't know if you can lay buy. I don't think you can lay buy anymore.
No, look, it's not something I come across actually.
Do you have it in France? Did you have it in France? Lay buy?
No.
Yeah, you probably know what I'm talking about, do you?
No, I've definitely heard of it, but it's not something I've done myself or that I've seen clients.
Yeah, lay-by. That's back in the days when people were responsible about their finances. But anyway, the access to credit is what we're talking about. The access to credit can be one of the biggest handbrakes on people to invest in property. So you get to a point where you want to start doing it. You might have even saved some money. And the mind boggles when I hear people say, I've got all these savings and it's offsetting my mortgage at 6%, but they're holding a credit card balance that's at 22%. This is basic stuff. You got to get the house in order. But what we're talking about here is what will happen for a lot of investors at a point in time, whether it's to get into the next property or to kickstart a portfolio, is you've got to start with debt consolidation before you can even start thinking about investing in property. So, Eva, let's have a chat about that. And I know you've got a really good case study here, and I think it'll be a really good way to break this down. We'll just go to a quick break. Stay with us. We'll get into that when we come back in a moment. Welcome back, everyone. Phil Tarrant from Smart Property Investment, chatting with Eva from Finny Mortgages, the crew over at finny.com.au, talking all things mortgages. And we've spoken a lot of different scenarios. We talk about private banking. We talk about SMSF lending. We've spoken about SME lending for self-employed. But this sort of, this is probably a little bit earlier on in the piece for a lot of people. This is around debt consolidation, about getting the house in order now in order to prepare yourself as a property investor in the future. And I think debt consolidation is possible if you have some assets, Eva, owner-occupier residence, which for a lot of people is the savior for clearing out their debts, high interest rate debts. You have a really good case study here. Perhaps we should start with that to give us a sense for how we can navigate this.
Yeah. So I think, typical couple in their mid-40s. They've got two children. They bought a house a few years ago. They have a mortgage on it. Mortgage is $600,000 plus. It's that's actually pretty good around Sydney. That's quite decent. Frank, so he works as a sales manager. He earns good money, 120, a bit of commission as well, here and there. And his wife, Sharon, she works as a teacher and she's on $90,000. So, I'd say it's quite typical around Sydney. And then so over the years, they needed a new car for the kids, got a car loan. They needed to renovate their bathroom. They got a personal loan to do this. And then, as you do, you spend money for the kids, you go on holidays, what have you. And they had a credit card with a limit of $15,000, completely maxed out. So all of that, those debts, every month cost them, over $2,000.
In repayments?
In repayments.
So how much was 30, 40, 50, 60,
so
70 something K?
73, yeah.
So that's so imagine the credit card would be at 21 to 23%.
Yep.
Car loans, depending
it was just under 10%.
Under 10%, like 10% for a car loan.
Yeah, it was huge. It was really bad.
When did they get the car?
A few years back, because they still had 4 years to pay on it. They just got a bad deal on that one.
10% on a car loan, 2 years ago, you get car loans at about 3%.
3%.
Yeah, 3%. And
it was a used car. It wasn't a brand new car, so the rates are a bit higher when you get financed for a second-hand car. But yeah, just a bad
and the personal loan which they paid for their bathroom, what sort of rate was on a personal loan?
It was almost 14%.
14%.
Yeah. Yeah.
This is madness.
Yeah. Yeah, they just never looked at it. They just, paid it every month without really checking. And on the credit card, only paying the minimum. So it just wasn't going anywhere. And
this goes to the point around education. This is exactly the reason why I do this podcast, Eva. 14% on the personal loan. If you have a owner-occupied property, $600,000 loan in Sydney, I would imagine there's a fair bit of equity. Now, let's say it's the median, right? So there's at least $400,000 of equity in that particular property, and they're taking a personal loan out for 14%. Is that from the same bank where their mortgage was?
No, it was all over the place. So they had their mortgage with CBA, the personal loan was with Citibank, from what I remember. The car loan, they did it through the dealership directly. And
so I reckon they just rocked up on a Saturday and said, "When in the new car, quickly give us one and we'll sign whatever you need."
That's exactly what they did.
Is it?
Yeah.
God. And they've never used a mortgage broker before, I would imagine.
They hadn't, yeah, that's right. Yeah. So that was the first time. All the advice that they had so far was from a banker.
Okay, so they went back to the bank and said, "I would like a loan to buy an investment property," and the bank went, "No way in the world." So they said, "No, you can't service it." Did they give them any solutions? Did the bank say?
No, that's it. They just said, "Look, you can't borrow any more money," which is true. You need to pay off those debts, which is true as well. And they just left them hanging, I guess, with that as a solution. That pay off your debt, $73,000. So it's not small, and come back to us when that's paid off, basically. That was the solution they were given.
And it's what happens when you go to a bank. They'll just put you into a machine and go, "No, the computer says no, on your way." Hence the reason why mortgage brokers now write 70% of all finance, mortgage finance. Right. So how much, what was their property? Well, I'm sort of saying I'm going to use $1 million as a median, but is their property worth a bit more in that? So let's chat
so
about.
Actually, after I met with them, to me, it seems obvious that they have equity there that we can use. And that's actually was their initial plan, to use equity to buy an investment property. So we did a valuation of the property. It came back at 1.2.
On $600,000 of debt.
Yeah.
So they'd have about just over 300 grand in equity at 80%.
At 80%, just over 310,000, which is plenty to consolidate the debts, to look at investing and still, not overload the property in debt. So
and you said they're in their mid-40s. So principal place of residence, good combined income. Would you say about sort of 210 plus some commission here and there? So still got probably 20 years of work ahead of them. So it would make sense for them to be leveraging that equity to propel themselves into property investment, but they've got to sort out the debt first. So a lot of people are going to think this is pretty basic, but you'd be surprised how often you see this, how often you see.
That's why I wanted to talk about it today. I thought I see it so often, and I also get very often that, I didn't know I could do this. So I think people think that they're just stuck with their debts and, okay, it might take 10, 15 years to pay it off, which that's what would have happened with them. And they just don't know there's other options there to look at it.
It's like literally so simple. And I'll see a lot of people, and there's companies that just do debt consolidation, right, who wrap up people's debts and find a better way to do it. But you find, and I've seen it, where people refinance their principal place of residence in order to free up equity, part of which is to pay down the interest or pay down the unsecured debt. What they end up with is a product, because on the way through, they normally refinance to a better mortgage anyway. They end up paying overall less money than what they were paying beforehand, their mortgage and their debt combined, just by refinancing. You see it all the time. And there's ways that happens as well. And maybe you can have a chat about, you might be moving from if you got to refinance your principal place of residence and you've been paying it off for 5-6 years and you're resetting it to another 25-year mortgage, it means you're extending the life of the debt that you have against your principal place of residence. So people need to remember this, correct?
Yes. Yeah, that's right. If you refinance for a term that's longer than what you had, technically overall you would be paying more. But for example, in this instance, we did a different split and we only had a 5-year term for that split to consolidate the debt. So that wouldn't extend the term. The credit card, there would have been, 10, 15 years down the track. The car loan still had 3 years. The personal loan still had 4 years on it. So we didn't extend the term there. Obviously, if you don't pay attention to that and you get $73,000 worth of debt for 30 years, that's not going to work out.
No. And this is what your mortgage broker can help you out with. And if you don't understand that, interrogate it, keep asking questions until you actually appreciate the dynamics of this. So, Eva, let's have a chat about the actual solution. We'll just go to another break. Stay with us, back in a moment. Welcome back. Phil from Smart Property Investment, chatting with Eva from Finny Mortgages, finny.com.au. So you spoke to them about debt consolidation. Did they get it straight away? Did you go, hey, do you know you could do this?
So the first answer was like, well, we don't have the cash to do this. We're actually struggling every month to pay everything. There's nothing left. There's no way we can get rid of it quickly. And so they thought the equity would only be available to invest or to do renovation in their home. But they didn't know they could basically use this to pay off the debt. So they just didn't know about the solution, never heard of it. So that was the first surprise for them. So I explained, we're just going to merge the 3 loans you've got, your car loan, your personal loan, and your credit card, 73,000 into one loan that we'll have against your home. So the rates will just drop to, 5.5%, which is what it is now. And then you just have to pay off that debt every month. You don't have to, send money to your credit card and your car loan and, to manage all that.
So did you refinance the principal mortgage against so you refinanced the whole thing and wrapped it up together?
Yeah, because they had the mortgage as well for almost 6 years, and the rate just wasn't right. So we moved that. So we moved the $600,000 debt, got a better rate. So they save a bit of money as well there on the monthly repayment. So we had the $600,000. We didn't use split $73,000 for the debts that we are looking to clear. But that specific split was only for 5 years. So they have 5 years to pay off the debt. So it won't increase, the overall interest they would be paying on the debts. And the good thing about that is that split now costs them $800 plus less than what they used to pay on the 3 different
2,000
loans that they had. So they can actually either free up some cash or use that cash to actually pay off that debt even quicker.
Yeah, which is a really good thing to do as well. They're much like you, these clients. You probably change their life.
Yeah, they're just right. Just really, and we get a lot of referral actually from people like that, because it's just $800 a month is huge. And you're thinking of being an enabler, right? Because you've turned that unsecured debt into debt connected with your property, your principal place of residence, which, if you've bought correctly in the right areas, in the right markets, is going up in value. So you imagine that just releases a handbrake for people to start taking control of their lives. Did you refinance it with a different lender, or did you stay with the same lender and just? No, we moved as well. Yeah.
Did you try and take it to the current lender and they didn't want to borrow it?
Well, they said to them, because they went to the bank and tried to get a solution from them that was never given. They're like, well, we might as well leave them. We just don't want to stay there anymore.
Yeah. And do you think they've learned a lesson? Do you think have they ripped the credit card up?
Yeah, that's all gone.
It's gone. So was that a condition? Like, did they actually have to remove the access to credit?
Yeah, so when we said, well, it's actually the bank that literally goes and pay out and close the credit card, the car loan, and the personal loan. So when you do like a cash out, technically the bank gives you the money and you do it yourself. But for debt consolidation, the bank will actually disperse the money and do it themselves, so they know it's done.
And they haven't rocked up and tried to get another credit card? Do you think they're not going to go that pathway again?
No, I don't think so. I think they learned the lesson. The good thing also is doing this, now we've freed up some cash, for them every month, and they could get that investment property right away.
Well, yeah, let's have a chat about that. But before we do, if you feel as though you don't have good financial diligence or control, don't have access to credit, thinking that you can sort it out later. If you're, my recommendation, if you're unable to clear your credit card debt every single month, don't have a credit card. Don't carry a balance. And I'm sure, the credit card companies aren't going to like me saying that, but people are still going to do it. So if you don't have the discipline, don't have a credit card. If you don't have the discipline, don't take store credit. Don't get a store card. Get rid of all that stuff, and you'll find your life will be simpler. Use a debit card if that's what you want to do, and have the debit card connected to savings. Offsetting a mortgage is another way to do it as well. So all that sort of stuff, smartpropertyinvestment.com, you can read all about it, but we'll go and chat with Eva and her team. So 73K in debt consolidation, big tick. You were able to refinance sort of 300 odd grand at 85% lend. So they still got 20% of equity inside the property. You can do a lot of damage with what's left there. Are they buying property now? Are they investing, or have they already bought an investment property?
Yeah. So at the same time we did the refinance and the debt consolidation, we actually released as well $120,000 for an investment purchase. So we had a third split there for the purpose of that. So they didn't touch it until they found a property. So we had on top of that a pre-approval, and we connected them with a buyer's agent to really find a property that would work for them and within their budget. And they did actually buy something. It's not settled yet, but it's in the process. So they bought a property near Adelaide.
Okay. Who's the buyer's agent? Can you tell me?
It's Paul Glossop.
Oh, it's a Glossop, was it? Okay. Yeah, there you go.
Yeah.
But you speak to these buyer's agents, and I get to speak to a lot of them on this show, and they'll tell you they see a lot of this as well. People want to take control of their financial future through investing in property, and often you've got to go absolutely back to basics, go clear the decks, and lenders like to see your ability to do that and also save some money. It's just a big tick, right? That helps.
Yeah, that was tick. And the property that they're buying as well would be positively geared for them. So on top of, obviously saving almost $800 a month by consolidating the debt, they would bring another $200 from that property, and they're really committed to really smash that debt and get rid of it.
So they've got a positively geared property, which is providing them income.
Yeah.
To help pay off the consolidated part of the debt from their early unsecured debt. Like, this is a game changer.
Yeah, it would be for them. It really would be, because they were just thinking, well, it's going to take at least 10 years to get rid of those debts, and just not going to happen. And now they have a property. So
Yeah. So I guess the key thing is that if you're holding unsecured debt
there's
and
a
you
way.
have a principal place of residence with equity in it, think about rolling it up into your mortgage if you're thinking about, and this is not financial advice, by the way, you need to go and speak to the right people around it. It's just how it can work. This can be a real enabler. If you're equity in your home and you're paying 22% interest rates on your credit cards, or 14% on personal loans, or 10% on car loans, that's probably better off set against your mortgage, which is connected to, hopefully, an appreciated asset, which is your home. So it's pretty simple stuff. Debt consolidation. Google it. You'll learn about it. And it could be one of the greatest things you might stumble upon if you're feeling the weight of unsecured lending.
Yeah,
cool.
Definitely. Yeah.
Do they send you like a bunch of flowers or a bottle of wine or something to say thank you? You probably
all of that. The
transform
best
their lives.
Yeah, no, it's great. Look, and they've been great people to work with as well. So, and yeah, they're already thinking of doing another property once. They're just so into it now. They feel like they've been, I guess, educated as to what needs to be done and how it can be done. So, and that's what we want to do, just to show people how simple we can be, actually.
And it doesn't need to be hard, this sort of stuff in property investment. And but just mention the shackles that are being they've been released from just by doing this. And you think of the second and third and fourth order impacts of that. It's, you free yourself up, you've got control of your future, you're under less financial stress, which is only going to lend itself to greater happiness. Your relationship's probably better. Your mental health is probably better. You can go from being, pessimist to an optimist. You're going somewhere, you're achieving things, right? And this is why, I see it in the best brokers that I know, they get a huge kick out of that. The fact that it's a seismic shift to all of those different areas. So you should get a lot of satisfaction out of that, Eva.
Yeah, it's great. Like, I feel useful. I feel like I've helped the whole family, because obviously there's kids there that just were also missing out when there's no more cash available in the second week of the month, really. So I've got kids myself. You have kids. Like, it feels sad knowing that that both parents are working hard, they're doing well, and yet it's a bit of a struggle. So
yeah, and it comes down to education. Absolutely comes down to education. You might not know, well, now you know. Yeah. Ask your mortgage broker around debt consolidation. You can go and speak to the team at Finny. What's the best way? Just on your website?
Yeah, website finny.com.au. There's a quick form there to input details and a quick overview of what's needed, so then we can match you with the best broker there that can.
What I would be saying, if you're holding unsecured debt ongoing month on month, have a real good look at debt consolidation. Have a real good solid look at it. That's either from Finny Mortgages, finny.com.au. It's FINNI. A lot of people ask FINNI.com.au. Eva will be back in another couple of weeks. Any other case studies you'd like us to look at? We're happy to check it out. Any ideas for what's next, Eva? I think Eva, you're gonna bring a guest along next time.
Yeah. Hopefully, a guest. We see a lot of immigrants now trying to buy properties, and obviously there is a bit of restriction around what visa they're on, and that used to be my issue as well. And it sort of got into broking, to be honest, because I got so many no's from a lot of banks, and the only way I got my first loan was through a broker.
Yeah, because by memory, if you're not a permanent resident or a citizen, you can't buy established properties. That still exists.
Yeah, there's restriction. Whether you can't, or the LVR will be lower, or you'll have to pay extra stamp duty. Like, there's a lot of things happening.
Well, we know French people don't pay their bills, right? That's probably the problem.
Never.
Very responsible people, the French.
Yeah. So we see a lot of those actually at the moment, and same thing, they're stuck. And that was the situation from this client. I'm going to try to bring in and talk about that, because it's we found a great solution for him.
Yeah, and that's great, because we have a lot of sort of migrant communities tune into this, and when they arrive in Australia, seeking a different life from wherever they are, from across the world, whether it's established first world countries like Europe or the UK, or I'm not going to say New Zealand's a first world country, but or America, through to sort of the developing world. Australia is very, very lucky to be able to attract migrants from all over the place. And often they start off renting property in property investors' properties. And there's always, once they quickly appreciate the Australian dream of home ownership. So accelerating them into property is a great way for them to continue to grow and build their lives. So I'm really interested in what you've got to say there, Eben. I'm sure there's a lot of people don't want to tune into it. Remember to check out smartpropertyinvestment.com.au, social media, Smart Property HQ. We'll see you again back with Eva in a couple of weeks' time, and we'll go through that, investing in property for our newer migrants. Do you identify as being a migrant, Eva?
Yeah. Yes and no.
My wife's a migrant. But she never called herself a migrant. It's migration, right? Yeah.
Yeah. I guess, look, I'm a citizen now and I'm well established there. But you always will have, that one person that reminds you were not born here. Yeah. Regardless how much they do for Australia themselves. Yeah.
Yeah, that's the way it is. Okay. All right. Thanks for tuning in. Thanks again, Eva. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.